We're now on the markets, about 15 minutes to the opening bell. Our next guest is Michael Shaoul. He's the chairman of Marketfield Asset Management. His Marketfield flagship fund beat 91% of its peers last year. Michael, great to see you. Also joining us is John, and also Dom is standing by down at the New York Stock Exchange as well to chime in. Michael, so we've gotten past Bernanke.
Yep.
Now what for the markets?
You know, I think now focus starts turning towards Europe, which I think is really the sort of big problem sitting out there. But there is a problem with European liquidity. The ECB really hasn't done anything to address it. Bernanke hinted as such in his speech, but didn't actually come out and say it. And
hinted what? Hinted?
I think he hinted, but more could be done in Europe. I mean, I think he said that he was optimistic that the Europeans would find a way around this, but that means they have to actually do something.
You mean so stabilization, the key there is what's going on in the Eurozone. Is that what you mean?
Yeah, I think if you look at what the ECB is doing, they are not expanding their balance sheet. The big difference between what the ECB has done since 2008 and what the FRB has done, the Federal Reserve has done, is the Federal Reserve has actually addressed the issue of aggregate liquidity. There's a lot more liquidity in the US dollar system than there is in the euro system.
And obviously this is one of the reasons why you're very worried about European banks and banks in general. Your view has been to look at stocks that have held up better than the rest of the group. But does that mean you go after the safe stocks or you go after the technology stocks you mentioned at the top of the program?
I think the Nasdaq 100 has stunning year-to-date performance. It's down 2.5% as with Friday's close. Now, it's more than just technology. The retail stocks, the healthcare stocks in that index have also done well. You don't have to have a purely defensive portfolio to actually be doing okay this year.
Michael, it's Dominic here at the NYC. We're talking to a lot of traders out here who are, yes, saying that there's low volume, maybe some stuff on their shopping list here, but you just pointed out a few sectors that we could look at. Are there any individual names that you could be looking at? Are there blue chip, large cap stocks that are dividend yielders? What's on your shopping list right now?
You know, as I say, we don't have an aggressive shopping list until Europe addresses its problems. This is still a dangerous market until that's finished with. But the stuff which I think you can hold on to, you know, at this time, it's a whole mix of non-financial U.S. equities. It is mostly large caps. I do think you want to look for good balance sheets, good cash flow, but you know, it's out there.
But would you be more aggressive, you know, once we hear more clarity from the Fed and Bernanke on QE3?
No, I don't think QE3 is the answer. I would be much more aggressive if the ECB actually did something new. If the ECB actually talked about addressing the level of liquidity within the Eurozone, that would make me much more aggressive. And until they're more aggressive, you know, we're going to be relatively defensive. Having said that, the U.S. equity market's holding up. So, you know, a strategy of being long some U.S. domestic growth and short European growth and emerging market growth, you know, has really kind of held up pretty well so far.
Emerging markets. So those who argue that the emerging markets have sold off more than the U.S. market, you don't believe that creates a buying opportunity? That's what you're saying?
No, I think that's bad news, not good news. I mean, you know, you could be long Brazil and be down 24%, or you could be down the Nasdaq and down 2.5%. It's fairly clear which market you really should be in. It's not the emerging markets at this point.
Let me bring up another market, because gold has been, you know, obviously an asset that a lot of people have bought in this, you know, in this crisis. I want to bring up a chart that we have, which is basically the spread between two ETFs, the Spider Gold Trust, as you can see, and also the Spider Dow Jones Industrial. Now, the premium, Mike, that's widened by the most since the gold ETF was started in 2004, meaning that you're paying a whole lot to bet on gold, and that stocks are way cheaper than that. That's the right bet? To get into stocks versus gold?
Yeah, I'll be honest, we've been pretty wrong about gold so far this year. We thought it was overdone at 1,300 or 1,400. I think you look at gold where it is today, it's a very popular trade, and it's going to continue doing well until its popularity changes. That doesn't necessarily make it a great long or medium-term investment. I think that once gold has got to this point against the equity market, it'll keep on going until...
So you're afraid to call a top on gold?
You know, it's much easier to call a top after it's happened. I'll call a top on silver quite happily.
On silver?
Yes, because silver peaked at $50 and it hasn't followed gold back up, and it looks to me like silver will not get back to $50. That I feel much more comfortable about. I mean, you learn to be patient calling tops.
Okay, all right, Mike, great to see you. Thank you so much, Michael Shaoul.